Good afternoon, everyone, and welcome to the analysts meet for Bank of Baroda's financial results for the quarter and year ended 31st March 2023. Thank you all for joining us. We have with us Mr. Sanjeev Chadha, the Managing Director and CEO of Bank of Baroda, and he is joined by the bank's executive directors and the Chief Financial Officer. We'll have a few opening introductory remarks by Mr. Chadha, and we have a short presentation followed by the Q&A session. Over to you, sir.
Thanks very much, Baroda. So let me just begin by introducing my colleagues. You will be familiar, but let me do that. On my right, we have Mr. Ajay Khurana, Executive Director in charge of retail banking for us. On his right is Mr. Lalit Tyagi, in charge of international banking and all our platform functions like risk, compliance, and audit. To my left, Mr. Devda Chand, who is Executive Director in charge of corporate and treasury, and also who is our Managing Director designate. To his left, we have Joydeep Dattaroy, who is ED in charge of digital, IT, and all our subsidiaries. And to my extreme left, Ian D'Souza, who most of you know, our Chief Financial Officer. Thank you.
Can we have the PPT, please?
So thank you very much for joining us this afternoon. I think it's after a long time we have been able to get together without the pressure of all of you having to rush to another meeting. So thanks again for that. So we'll just start the presentation by a small focus on the growth numbers. I'm completely aware that you received these numbers at the beginning of the quarter, but just to put in perspective the profitability piece that we've declared today. So we have been guiding right through this period that from our perspective, in order of priority, we believe that the most important thing is underwriting standards and credit quality. Once we ensure that, we try to protect our margins or improve them. And if it is possible after that to actually go for growth. We had also guided at the beginning of the year that finally, after very many years, we believe it is possible for us to have a margins and also to grow at a reasonable pace. So we are really, therefore, very satisfied with the kind of growth figures we have seen after a long period. What is equally encouraging again is that this growth that we see has come from almost all business segments. First of all, between domestic and international. Domestic has grown by more than 16%, which is faster than the industry, while international has grown by 30%. As some of you might recall, we have been discussing that this robust growth in international was partly because of the fact that margins were depressed in corporate lending the last year, and therefore we found better margins in the international book. Nevertheless, the growth has now moderated from about 40% to 30%, and we believe that as we go ahead, as opportunities in the domestic market improve, the growth in the international book should be pretty much in line with the overall growth as we go forward. Equally importantly, if you look at the segmental growth, it is driven largely by retail. So organic retail continues to grow at a very robust pace by about 27%. This again is part of our board mandated strategy, which requires us to have a larger proportion of our balance sheet in retail. So this year itself, we have increased the percentage of retail loans by about 2 percentage points. We expect to continue to do that as we move forward. We have been guiding that if our growth is X, we would want our retail growth to be 1.5X, corporate about 0.7X, so that over a period of time, we can achieve this portfolio composition change that we would want to do. But what is equally satisfying is that corporate, which had been under pressure in terms of margin, therefore we chose not to grow that very aggressively. This year has turned up a smart growth of about 13%. And going ahead, we believe that corporate will be contributing more to the growth and also while ensuring that margins are intact or improve. Within retail, the sustainability of this growth is largely predicated upon the fact that this growth is coming from a large number of business segments which are largely unrelated. So you have growth from home loans, which is about 19%, which is the slowest of these segments, but the others are growing even faster, which means auto loans, education loans, personal loans, all of these are growing much faster, which means that as we move ahead, we can be a little more confident about sustaining this pace of growth, which is also something which is indicated by the disbursement momentum, which is again gathering pace. The challenge for this year, of course, next slide, has been more by way of deposit growth, I think, for all banks. There also, I think, for us, it has been a relatively benign outcome. The gap between deposit growth and advances growth is possibly one of the least for us. So overall deposit growth is 15%, loan growth is 19%. And if you look at the lower quadrant, you will find that the credit deposit ratio, and particularly the domestic credit deposit ratio, which really is key, because international growth very often gets funded by instruments like medium-term notes. So the domestic credit deposit ratio is just about 75%. So there's a lot of room which is still there in terms of growth, and we are under no pressure whatsoever in terms of liquidity as we move ahead. Within the deposit growth, CASA growth is about 8%, and domestic term deposit growth is 17%. And this is something which is pretty much par for the course, because as the differential between the saving rate, which is about 2.75% for us, or 2.8% for us, and the term deposit rate, which are moved north of 7%, as it expands, I think you would expect that more and more customers who have been maintaining savings account deposits would like to move them to term deposits to the extent possible. In terms of next slide, please. Yeah. So in terms of how we compare with the industry, you will again find that we compare fairly well with the industry. So our growth is better than both industry and scheduled commercial banks by a fairly significant margin. When we talk of industry, we have a set of 8 banks, public and private sector, who have declared results so far. So it's about 4 percentage points higher. Similarly, advances growth again is higher than both industry, the set of 8 banks, as well as SCBs by a significant margin. So we have been gaining market share while keeping our margins intact or improving. In fact, margins have been improving, as we will see in the next slide. So if you look at margins again, we have had improvement in both yields as well as having a reasonably tight lid on cost of deposits. So NIMs for this quarter, actually, domestic NIMs were something like 3.6%, which is a record for us. And overall NIMs exiting this quarter was 3.5%. For the full year, it was about 3.31%. So given the fact that the exiting quarter NIM is significantly higher than the overall for the full year, we believe that we can be fairly positive about maintaining our year-end net interest margin into the new year also as we go ahead. Next slide, yeah. So if you were to again have how much have we really bettered the industry in terms of margins? So industry has improved margins by about 4 basis points for the quarter. Some banks did have a bit of a slippage. For us, they have improved by 16 basis points during the current quarter. Similarly, NII expansion has outstripped the industry, both in the quarter as well as in the full year. In terms of profitability, as a consequence of both growth and margin expansion, we have had a very robust increase in the quarter YOY growth, which is about 34%. Operating profit again has gone up very smartly during the quarter with a concomitant increase in profit before tax and profit after tax. So profit after tax at 4,700 plus crores plus is again a record for us. Moving to the annual numbers, you'll find that this quarter was not too much of an outlier. In probably almost every quarter, we have been able to have a significant improvement as we have moved ahead, with NII for the full year moving up by 27% and operating profit by 20%. I think this operating profit 20% is significant because while we had been reporting profitability increases, it was mostly driven by credit costs coming down. Now we see the operating metrics also kick in. This is a function of both costs as well as revenues, as we'll see as we move ahead. For the full year, the profit has come out at about 14,000 crores, which again is the highest ever by a very, very big margin for us. Now, how do we compare in terms of profitability vis-a-vis industry? There again, whether we look at NII growth, OpEx, credit cost, PAT, everything I think is worked out well for us. What I would particularly like to draw your attention to is the operating cost increase. I think this really is become the comparative strength of the bank. I think there is, of course, this year's business environment was very favorable. Credit costs have been trending downwards. But what was key difference for us was that while most, again, competing banks have increased both revenues and costs in tandem, we have been able to contain our costs. In fact, the number that you see, 13% vis-a-vis 19.6%, understates the difference between us and other banks. This is because that our number is inflated, by the wage increase, which fully kicked in this particular quarter, and there were certain other one-offs which Ian will take you through as we move along. But again, to re-emphasize, we believe that the key comparative strength for us as we go through this cycle is A, that we are growing faster than our competitors, and B, by very large margins, our cost growth is very well contained. In terms of improving asset quality, this is something that we have seen even as we had gone through the COVID cycle. The gross net NPAs continue to trend downwards. Provision coverage ratio is very high. Slippage ratio, we had guided between 1 to 1.25%, I believe, so we are at the lower end of the range. And the credit cost, of course, has come down significantly below where we expected to at about 0.5%. I think the next slide is again something which is important because it gives you something of an insight into what are we likely to see as we move ahead. So if you see the SMA figure, this used to be as high as 2%, has then been stabilized at about 0.48%. And this quarter, this TRILIC figure has come down to 0.32%, which means that the improving trend when it comes to credit quality in terms of future prognosis continues. And this is again driven largely by collection efficiency, now stabilizing at a very high level. So as a consequence of all this, the capital position is very, very healthy. What I would want to draw your attention to is the fact that this year was exceptional in terms of the asset growth that we saw. Despite that asset growth, despite our earmarking 20% of our profits as dividend, we have ended the year with a capital adequacy ratio and a CET1 ratio higher than what we started the year at. So if we were to now look at any circumstance in the next few years, I think we might probably again be agreed that this year's credit growth was probably the highest which we are likely to see. So assuming a moderated credit growth and profitability, which again seems to be strong, we are likely to be self-sufficient in terms of generating funds for our growth as we move ahead. And the CET1 ratio, equally importantly, has actually moved up by 1 percentage point despite the dividend payment that we have done. The next couple of slides are on, again, how we are doing in terms of digital. I think this has been the key enabler which has allowed us to attain the twin objectives. A, to have growth which is better than industry, and B, to have costs which are lower than industry. And the lower costs in particular have been enabled by digital. Today we have a physical footprint which is substantially less as compared to what it was 2 or 3 years back. In terms of manpower on our rolls, it is also lower. But nevertheless, we are able to have industry-beating growth, and that's largely because a growing proportion of work is getting done through digital. It is through digital that we are able to reach our customers. Today, Bob World has got 30 million active customers, and we have done, I think our team has done a great job in terms of the penetration. But I think in terms of the leveraging of that penetration to get better cross-sell, better revenue opportunities, we are just about scratching the surface. So I think there's a lot of upside which is left as far as leveraging this digital footprint is concerned. Equally importantly, I think in terms of some things that we have, metrics that we see, for instance, the best proxy for a state-through processed digital loan is the e-sign, and we are number 1 there. So we are the 4th largest bank, but counting all banks, public and private sector, we are number 1 in terms of e-sign. So a lot of, again, positives when it comes to the digital story of the bank. So that's in terms of opening remarks. Thank you very much. And now open to questions.
Thank you. Thank you. If you can please raise your hand if you have a question. We'll get the mic to you and you can ask, and if you can please also introduce yourself. Yeah. I think the question, yeah.
Compliments to you, Chadha Saab and the entire team here for the fantastic results of Bank of Baroda. I think it is befitting to congratulate and compliment you. Even personally also, I think you will be presenting the results of this quarter as your last results of Bank of Baroda. And you have done a fantastic job, sir. Not only made the bank very, very strong, the balance sheet very strong, but even the business growth in this environment where bearing some small public sector banks, others could not reach this kind of credit growth and this kind of asset quality. So my compliments to you. Sir, now the question comes, number one is that on the treasury front, like I think this, especially in this quarter, our treasury income is 297 crore as against 1,142 crore. So going forward now when the things are easing out, I mean the rates are also softening or rather stable, where do we see, the profitability coming and the treasury contributing to this profit more? So some color on that, our book, H2M, HTM and AFS book, and what do we see in the coming quarter, the treasury performing? How do we see it? This is one. Yeah, yes, sir. Second is, sir, on the employees cost, it is increasing in every bank because of the wage revision and also the pension, additional pension. So going forward now here it is, I think 3,000 crore in this quarter is against 2,520 as far as salary is concerned, and total employees cost also increased by about 500 crore. So whether it is stabilized now at this, like can we take that every quarter it will be around 3,800 crore, or some more provisioning is to come? Because you of course you control the cost overall, you said as compared to the business, but still in absolute terms it is increasing, and similarly the other expenses also, which is from 2,800 crore to 3,100 crore. So whether going forward is stabilized. Now third one is on the slippages, which is more or less under control, but in this quarter increased little bit. So, and slippages and vis-a-vis the recoveries also. So on the NCLT, now when the things are progressing, though of course we again read there is some problem with the government guarantee and some issues are still there. So with the NARCL and NCLT. So some color on the going forward on the recoveries and credit growth sustainability. So these are the few observations and some questions, sir, in this round.
So I think that pretty much covers the full presentation. Thank you very much for those questions. So I'll just make a general remark and then I'll hand over to my colleagues to answer specifically in terms of treasury, employee costs, slippages, NARCL, and the rest of it. The general remark again I would make is only this, that we have tried to construct a business and a balance sheet which can absorb certain one-offs which might be there because of the environment. This year the one-off was on account of the treasury losses because of the fact that rate increases which normally happen over a 12-month period pretty much got compressed in the first quarter, and the results that you see are despite those treasury losses, right? So I think as we move ahead, and if interest rates cycle was to reverse, which seems to be likely, I think that is an additional upside which is available to the banks. But as far as we are concerned, we would want to make sure that we plan again for the future without accounting for these positive one-offs. You might want to take into account negative one-offs, but the positive one-offs is what you don't normally account for when you plan for your future. Now coming to the specifics, I'll again hand it over to my colleagues. Treasury first, Chand sir.
If you look at treasury, there are three components which is charged to the PL. One is the interest income on the investment, and then the trading profit, and third is the depreciation. If you look at the current financial year that we have declared, the increase in interest income is almost 5,000 crore. And which is 25% increase as compared to a book increase of roughly around 15%. The trading profit is something around 1,100 crore, and the depreciation provided is something around 900 crore. So as a bank, what we look into a different scenario is to how do I optimize all three components, right? So the moment you sum it up, the depreciation is only the negative item out of these two positive items. As a bank, the only last time also we articulated that can I create a what you can say a delta vis-a-vis the book increase, and precisely we have done that in this year. The interest income increase is so substantial. Even if there is a dip in terms of trading profit vis-a-vis last year, the income is far more than the dip in the trading profit, right? So that is what actually we are going to optimize. And earlier also in one of the conversation we articulated that we do have a higher FRB book, right? So that gives me a substantial upside in a rising interest scenario. So going forward also, 2-3 scenario can happen. If interest rate goes down, then the trading profit would go up, but the interest income again would take slightly a beating. If the other scenario, the same way it would continue. So broadly, the contribution out of treasury would continue with the same. And our strategy would be to how do I optimize the combined contribution vis-a-vis the book increase, and that has to be higher than the book increase. That is what the stance we carry.
So employee cost, I think Joydeep and again the CFO can talk about.
Yeah. So on the employee cost, I think while there has been an increase in the last quarter, largely that's because of the wage revision that kicks off every 5 years for public sector banks. So we have started taking provisions for that in this quarter, in the last quarter, and a little in the December quarter also. So that is a new thing which has got added. Secondly, there's as per the service conditions, depending on the increase in the operating profit, employees are eligible for a performance-linked incentive of some days of the year. So that again has been factored in this time in this quarter's results. So both these are new things which have got added in this quarter, because of which you would probably see a little bit of increase in the employee expenses of the staff cost for this quarter. But for the year, if you the 11.5% increase that you see, if you net off these two, being the one-off expenses or the expenses that have come this quarter itself, the increase is only 5%. So that way we are very, very well contained as far as the employee cost increases are concerned, and we see that being able to be maintained. And going forward, since now we have started the provisions on the wage increase, etc., and PLI also has been taken into account. So that's also baked in for the future, for the coming year also. Any abnormal increase, etc., won't happen now. So from that, etc., that part has also been covered. Slippages.
Yeah. Kunal,
regarding slippages and recovery. If you have seen our overall whole year, 10,100 is our total recovery, as against 8,100 our total slippages. And in fact, the recovery in return of account is also increased substantially, around 27% from the last year. So going forward, the trend is going to remain the same. Our recovery will be that is what is the guidance. Recovery will be more than the slippages, and also the recovery in return of account also will be almost in the similar amount. And as far as NCLT and NACL is concerned, NACL as of now there is no account that got settled in our bank in 22-23. So 23-24 there are 5-6 accounts which are under process. The process which includes even the other ARCs also, because of the Swiss challenge method it has to run through. So we are not sure that how many accounts are going to actually going to NACL as of now. This is the status.
We'll take the next question.
Yeah,
at the back there. Yes.
Yeah, hi sir. This is Nitin Agarwal from Motilal Oswal. So a few questions. One is around the loan growth. You talked about that FY24 can be relatively moderate in terms of growth. but FY23 we have already grown like 5% higher than the system. So do you want to talk about as to what levels of growth are you looking at in FY24?
So our sense is that the system growth might be about 12 to 13%. We would want to make sure that if it is possible, keeping the other two metrics of underwriting standards and margins in perspective, we might want to grow a bit faster than the system. So I think if the system is 12-13%, we might be 13-14% there or thereabouts. That's what we are, as of now, putting in our projections.
Right, sir. And secondly, on margins, is it fair to say that margins have peaked out this quarter and you can see the trajectory reversing from Q1?
So I think what you are saying is probably correct, although let me also confess that this quarter the margin surprised me on the upside. But our sense is that we have the overall margin of about 3.31% for the full year. And we have an exiting margin of 3.53. So even allowing for some moderation, I think we should be able to protect our margins as far as the full year margins are concerned.
Right. And sir, over here, if you can also talk about your international book yields and as well as the cost of deposits, overseas deposits, because there is a very big change that is happening quarter on quarter on both the aspects. Yeah. So where do you see this settling somewhere and what is really driving this big move?
So I think so when we look at our overseas book, we look at it in two perspectives. One is, of course, in terms of how the overseas opportunities are in the context of domestic market. Last 1.5 years, the overseas opportunities were more attractive, so we allocated more capital there. I think now possibly time has come when we're looking at inline growth. But as far as the profitability is concerned, the broad calculation that we have is we have a net interest margin of 2% there, right? But our operating cost there is less than 20%, which means you are left with 1.6% post-operating cost. Credit costs are negligible, right? And we have seen this right through. We have tested our portfolio in terms of interest coverage. We're very confident of that. So effectively speaking, you are ending up with a ROA, which is higher than the domestic book. So as the domestic conditions become more benign, there are more opportunities, particularly on the corporate side, we believe that probably on the domestic side, the opportunities are going to be as good or better. So we would expect an inline growth as far as the international book is concerned, but the international book for us is not margin dilutive at all.
Right. And sir, lastly, we have been having a very strong asset quality. This quarter we reported a very sharp decline in provisioning. So did we not think to make some extra contingent provisions this quarter because you know that ECL requirement will be kicking in sometime and even the troubled airline and the other exposures are there. So did you not think about making some extra provisions?
अब आपने सोचा तो हमें भी सोचना पड़ेगा. But let me put it this way. I omitted to mention it. So this year we have made a 500 crore provision for the airline account, although it is a standard asset for us. So we normally do not discuss specific accounts, but in this case there's a NCLT filing, so there's information in the public domain. Apart from what is guaranteed by the government, our exposure is about 1,300 crores, and we hold again tangible collateral security, not primary security. Primary security coverage is full. We have tangible collateral security and corporate guarantee, which is nearly about 1,000 crores. So we have made sure that we are more than well provided for any possible downside as far as that account is concerned. So we have taken your advice. Thank you very much.
Thank you so much, sir. And do you also want to clarify the ECL provisioning requirement number also?
So I think that's something which is still in the realms of future RBI dispensation in terms of what do you calculate, how do you allocate provisions, whether you can hold them and then draw upon them once the requirements come in. So we shall wait for that. But let me just put it this way. So in our view, the normal cycle credit cost should be about 1% for us, right? As of now, we are below that. I believe that whatever ECL requirements might be there, we should be able to absorb them within this figure so that the current trajectory of profitability that we have, that remains intact.
Right, sir. Thank you and wish you all the best, sir.
Thank you.
I think Saurabh had a question.
Sir, just one question. On the subsidiary business, there was some news that you're looking to do something with the credit card business. Can you talk about that?
So, Jaideep?
So the credit card subsidiary, I think we have started a process to get in some investors. We're looking at both strategic as well as financial investors who could add value to the company as it moves on its growth path. And I think the company has been doing pretty well over the last 1 or 2 years, as you would have seen. And in the last year, I think our credit card company was in terms of growth, registered the highest growth in the industry among all the credit card issuing banks in terms of growth percentages. So its growth rate was somewhere around 76%, whereas industry average was maybe just around 14% or so. So that's the growth that the company has shown. And in terms of the investor process, I think we are in the midst of the process. We have got a fair amount of interest from the market. There have been some investors who have applied. We are going through the diligence process. Our diligence room data room has been created, where the financial and the legal diligence, etc., are going on. And after completion of that process, we will probably be able to announce the investor. Thank you.
Thank you. We'll take a couple of questions from Zoom. Maruk, you had a question?
Yeah, hello. Good evening, sir. Good evening, sir.
Yes, Maruk.
Yeah, hi. Good evening, sir. Sir, congratulations to you and your team on a very strong set of numbers. So I just had a couple of questions. Firstly, in terms of your personal loans, of course, that portfolio has done very well in terms of growth. But are there any niche segments or niche areas that you cater to? Of course, I'm not looking for I am looking for the breakdown between salaried and non-salaried. But even within that, if there's any particular geography or any segment of customers that you would be targeting, because this is a very competitive segment already.
So thank you, Maruk. Thank you for joining us. So I think for us, this is still a portfolio which is in its infancy. So the bank had invested again in a data lake some years back. Now we are able to put all that data to use to identify the right customer and also to determine what is the kind of exposure we might want to take on that customer. So it is pretty much driven by data analytics, which takes into account everything, including again the profile in terms of employment, the kind of transactions that you have, etc. For the moment, again, we are fairly satisfied with how this portfolio is performing. I think if you would look at the analyst presentation, you will find one data point which might be useful, that if we look at NPAs in the home loan segment, they are about 1.5%. Currently, as we speak, we do acknowledge that this is a growing portfolio, not fully seasoned. But currently, as we speak, the NPAs there are about 0.89% odd. So for the moment, the portfolio is performing very well. And our loans are limited only and only to our existing customers who have their account with us as we speak. As the account aggregator opportunities presents itself, we might want to go beyond our customer base. But in terms of our own customer base, to my mind, there are enough opportunities for growth next few years. So for the moment, in terms of customer profile, all of these are BOB customers, and our choice is based upon the analytics that we derive from our data lake.
Okay, sir, thank you. And I just had one more question. On this particular airline account, was it in SMA category in the previous quarter? Because you talked about a stress group in the previous quarter.
So I think, to the best of my knowledge, there were no irregularities in the past. But the fact is that I think all of us are aware that this sector has been under stress. There are some airlines which again are either backed by a large group or again are market leaders. So there were some vulnerabilities that we were aware of. But I think the current challenges have come in some ways from circumstances which actually go beyond our market. I think the company has gone on record to talk in terms of engine availability and those kind of issues.
Okay, sir. Thanks a lot. Thank you.
Thanks, Maruk. Rakesh Kumar, if you can please unmute yourself.
Yeah. Hi, sir. Can you hear me, sir?
Yeah, very clearly. Thank you very much.
Thank you, sir. So just a couple of questions. One is relating to, a couple of notes of accounts there. And just to reconfirm, what is the total standard stressed account number? That is 10,000 crore approximately?
Yeah, I think, Kurazam.
Yeah, 11,000 crores. 11,000 crores.
10,700 crore approximately.
Yeah, it is 11,000 crores.
Okay. And the provision thereon is 10.7%, sir? Provision outstanding on those standard accounts?
No, standard account provision, total provision.
No, the stressed standard account provision is 10%, around 10.7%.
For the stressed, are you talking about restructured account or the standard stressed account, SMA? SMA accounts, we do not provide anything.
No, stressed restructured numbers, what is there in the notes of accounts, couple of notes of accounts. So there the outstanding provision is 10.7%, just to reconfirm, sir.
Total standard provision is 5,800 crores.
So excluding the provision for the standard account, the provision?
It is all inclusive. All inclusive, the accounts which are standard and provision, the provision is 5,800 crores. Specifically for SMA, we do not provide any, account-wise, no provision is provided.
Okay. And secondly, sir, referring to the notes of accounts number 15, there is a lot of, reduction that we have seen from Q2. So similar notes of accounts number 15 in Q2 and for Q4, there is a lot of reduction that we have seen in the exposure. So do we see further reduction in that number, the stressed account number, which was under resolution? And what is the impact of this reduction on the interest income line in this quarter?
No, as far as restructure is concerned, our book is reducing. Last quarter it was 18,500. Last quarter, this quarter, this is 16,000. Now last year it was 18,500. This year it is 16,000 crores. So and overall, the stress which was 4.67%, other than NPA, it has been reduced to 2.97%.
Correct, sir. So we see that there is a lot of reduction in the provision also that we have seen. So is there any impact on the interest income line also of this reduction?
No, interest income, because provision is, here these are all standard accounts.
Okay.
Interest is booked. So there is no risk of any, on impact on interest income.
Correct. Okay. Got it, sir. Got it. And sir, on this wage revision thing, like a total provision now outstanding is only 500 crore. So we have made an additional 300 crore this quarter. That's it.
Yes.
Okay, sir. Okay. Thank you. Thank you so much, sir. Thank you.
Thanks, Rakesh. Who else has I think right there.
Hats off for excellent performance to the whole team. Couple of things. In fact, you answered most of the questions. A few things on this wage revision, which comes every 5 years. You mentioned you have made a provision of 800 crores. What is the expected hike and when is the agreement going to happen? If you can give indication itself.
So I think Lalit possibly. Right. The success question goes to the newest ED.
So it goes like that. So there is one calculation which goes into mind as what was the percentage in the last hike and what are the expectations going forward. That is one. The second one is that the provision which we have booked in this financial year is for the 5 months only, because the wage revision is due from 1st November 2022. So going forward, as the discussions progresses, we may build in the incremental provisioning as the discussion with the industry progresses. But as of now, we believe that we are adequately provided in terms of the anticipated wage hike.
What was the last increase 5 years ago?
It was, if I am correctly wrong,
Around 15%.
15%.
Okay. Now inflation coming down, possibly it could be lower, right? Next
So
is
you can't, it's difficult to conjecture on that point because.
Sir, next is very excellent deposit growth rate, world beating 15.1%. What do you expect in the coming year? Because sustainability is a key here. Advances is very easy to give. And what are the cost trends for the deposit growth?
So we are conscious that we might be coming towards the end of the rate increase cycle. So we have tried to make sure that the incremental deposits are such that they can again get repriced should the interest rate cycle turn. So most of our deposit growth which has happened, CASA apart, has come from deposits with a maturity of 399 days, which is our flagship scheme where we offer the highest rates or lower, which means that even if the interest cycle were to change, we have not tied ourselves into a scenario where we might again find that loan yields are coming down and deposit yields are stuck. So we have enough flexibility built into the balance sheet.
So the number for the deposit growth ahead, some kind of indication?
So I think for us, we would expect that, again, as a general proposition, you would want to fund your loan growth entirely from deposit growth. This year also, despite the fact that deposit growth was challenged, rupee to rupee, our loans have been funded entirely by incremental deposits. And that's what we would want to continue, which is why you find that a domestic CD ratio, despite the tightness in the market, is just 75%. And there's enough room for growth there.
Now, on this airline account, which we mentioned, we have been very ultra conservative. In fact, you gave the number and being a standard account, and in fact, the industry is doing well. Now, looking at a worst case scenario, what the company says, there are a lot of collaterals you mentioned. Corporate guarantee, of course, is difficult to implement, but this collaterals and land, what will happen is what you have provided, ultimately it will come off in write-backs and recoveries. It will add to profits in the coming year, right? This collaterals they have, what is the time frame it takes to monetize this collateral? Because they are talking about land in prime areas like Worli plus extra, you may be having specific known to you. What is the time frame to monetize this thing?
So I think
particularly the real estate cycle is very good now.
Yeah. So I think that's a hypothetical question. But from our perspective, we just try to make sure that whatever is the downside, since you have room to make provisions, you do that. If this account had not been there, we probably might have made a general provision anyway. So it's really again, so why are credits cost at 0.53% today? It is because whatever you could anticipate for the future, you took care of it in the past. So that's what we continue to do. But in terms of specific recovery cycles, I think that might be possibly a too detailed discussion for this forum.
Okay. Now, lastly, on a very important subject of ECL, which was raised. Now, some of the banks, this is a very sweet spot in the cycle with very low credit cost. It's the best time to make provisioning, and RBI is making us ready for it. Although they had prepared us several years back and asking, regular financial models from us compared by direct norms to IFRS 9. Now, other banks like Bank of India, Can Bank, Union Bank have given us a number to ponder. Now, if you can also be transparent and share the number based on the models you have been reporting. Although we know we are the best bank compared to all the banks, and we have been doing accelerated provisions, including some account we mentioned, this is accelerated provision, but giving the number. So what we are prepared for, that transparency we expect from you.
Normally we would not give this number. आपने इतनी तारीफ की, आपको मना भी कैसे करूं? तो मैं अपने CFO को question hand over कर देता हूं.
So we believe it's a bit premature to come out with a crystallized number because the regulations itself are in discussion with RBI. As you're aware, there's a discussion paper out. Banks have responded to the discussion paper. But I'd like to make 2-3 points and attempt to answer your question in a different way. One is if you look at our overall financial from a asset quality perspective, you would see our NNPAs have been steadily declining. They are about
8-9% is the NNPA ratio. So the unprovided NPAs are very low. Secondly, in terms of our provision coverage is around 92%. And thirdly, the stress book, which is the SMA acrylic 1 and 2, where your ECL will actually hit you, is at all-time lows at 0.37 basis points. The other thing in terms of restructured book is around just a standard restructured book is around 1.5. So these are all elements where your ECL will push and create pressure. So all these elements, I think, are working well and should track better. And having said that, maybe our number, it's an estimate right now, would be in the range of 1 to 1.5% of loan book at this time.
Okay. Now,
Thank you.
This is really very good. I have one point on this. I'll just add. You are having consultation with RBI on that. Now there are lots of thoughts which are coming on IFRS 9 ECL and the secular-based system. Now we are moving forward from a secular-based system to a principal-based system. But we should have clearly one secular-based system is working very well, or that IFRS 9 ECL. But if there's a thought process of a hybrid system, which has not been implemented anywhere in the world. So there should be one system. I feel if you do that, it will help in uniformity across the system, and wishing you all the best.
Thank you, sir. There's a second row.
This is Sharat Chandra, investment advisor. Thank you for giving me the opportunity to ask this question. Good that this year has been extraordinarily well. Your deposit growth has grown at 15%. Your bulk deposit rates, I don't know whatever they are, you have been able to grow at 65%. Credit, obviously, you have been able to match the industry. You showed comparison about, industry and how your growth has been better. Now, looking as a shareholder, with a longer term perspective, in the last, 10 years, a full decade, your return on equity has been low single digit. This is the first time that you have shown 15% return on equity, which is the expectation, because as a risk capital holder, I expect a higher rate of return vis-a-vis my fixed deposit rate. So, I would like to ask you, why are you running after growth? Because bulk deposit at 65% growth is basically to match your credit growth. Why don't you just be more, choosier about, what things I lend and what thing I'll not lend? And can you tell me that has the board discussed and probably the management team has discussed is target return on equity, which you have in mind? Because if that is not in mind, this is a good period, and so that's why you have made good money. And so that's why the stock price has gone up, and it's first time trading at more than 1 times price to book. So, and if you can tell me, if there is a target which you have set in, what are the cultural and structural changes which has happened, in the last couple of years in the bank, that I'll be confident that you'll be able to maintain that double-digit return on equity. Thank you very much, and all the best. And apologies if I have been slightly blunt.
No, not at all. I think most welcome. So I think in terms of the mandate from the board and also what we have been guiding, the mandate from the board is that we would want to insulate the bank from the cyclical development that we have seen, which was, as you said, responsible for an extended period where returns were subpar. And if you were to go back and see what produced those subpar returns, it was largely the corporate credit cycle. So today the corporate credit cycle is very good. It is working in our favor, but there's no doubt it will change again. So as a bank, what you can do is you prepare for the next cycle by making sure that you are less dependent on corporate loans as compared to what you were. So our corporate loan book used to be 47-48% of a book. Today it is down to 43%. So we believe that before the next cycle comes, if we can have a more balanced portfolio, then the kind of challenges that we saw the last time around, they are likely to be addressed. So that's number one. Number two, again, in terms of growth, we actually, I started again my opening remarks by saying that for us, priority number one is underwriting standards. Number two, margins. Number three, growth. And we do not chase growth, which is why in the corporate book last year, we had a growth of only 5% because the conditions were not conducive to having growth with margins. Third, we never take a growth target for the year. But also in my opening remarks, I mentioned that we will like to grow at industry or better, right? So maybe 1 or 2 percentage points more than that. So you try to make sure that you are not setting yourself targets where, as you said, by chasing your targets, you end up in a situation that you had not bargained for. And in terms of the changes that have happened in the bank, which should give us confidence for the future, I think first of all is the technology piece, which I think where the bank over the last few years has emerged at par or better than probably any other bank, and we had some metrics that we spoke about. The second to my mind, apart from technology, and more importantly, applying that technology again to do business, is really talent. That is what distinguishes one bank from the other. And I can say it without hesitation that this bank, public and private sector included, is the best example of a bank which is able to attract quality talent, retain it, and use it to build businesses. Particularly, I think the biggest risk for any bank is the CEO, right? Even if I say it myself. And how do you mitigate that risk? By making sure that people like the Chief Risk Officer, again, are experienced, they have industry standing, and they can give advice without hesitation. So today, as we speak, our Chief Risk Officer is a market professional with enormous experience. Our Chief Financial Officer, again, is a market professional with enormous experience. So we have tried to build a team which can insulate ourselves from this cycle, but we welcome any feedback, and we believe it will help us become better. So as you said, you give targets again, and you get into the trap that you outlined for us, right? But we will try to make sure that we outperform the market. We bow to market conditions, but we believe in any market condition, we can try to outperform the market.
Thank you.
Thank you. We'll take a couple of questions. The last couple of questions. Saket Kapoor is online. Saket, if you can unmute yourself and ask your question.
Yeah, Namaskar, sir.
Namaskar.
Yes, sir. Sir, you spoke about the net interest margin for the next year to be in the trajectory higher than what the average for this year was. So we are looking for a band above 3.31, and it will be lower than 3.6 that we exited for this year. That should be the number we should work for the next year.
Yeah. So I think what you are saying is correct. We believe that the 3.31 average NIM that we had, we should be able to protect that, which means we should end up there or maybe a little better than that. And we do believe that the 3.53 exiting NIM that we saw gives us that little bit of room to again make sure that we can absorb a moderating interest margin regime.
Okay. And sir, on the ROA front, sir, what should be the trajectory that we exited this year with our 1.34 annualized number, and as for the quarter, sir, and 1.03 was for the year. So what should be the ROA trajectory?
So I think we had guided that we would want to hit a 16% ROE and a 1% ROA in 23-24. We have hit that 1 year in advance. Now we believe we should be consolidating around those levels. So I would believe that our guidance continues to be 1%, and as a consequence, the ROE, which is as of now about 18%.
Sir, come again, sir. I missed the number, sir. What it should be?
1% and between 16 to 18% ROE, depending on what your capital base is.
Sir, now for your equity investors, sir, I think so the dividend payout is also significantly higher. And thank you to the board for declaring a dividend of 5 rupees 50 paise per share. Kudos to the team.
Well,
sir, but
I hope I'm speaking to an analyst, not a shareholder.
Sir, I am a shareholder, sir.
Okay, both hopefully.
Sir, no, sir, I'm a mere shareholder only, but I'm trying to learn the language and the terminology. So, so the moot point as an investor, I would like to understand. Firstly, sir, what is in the current banking cycle, from the NPA to the cleaning up exercise, and now with the credit cycle and the higher interest regime, what should investors look forward in terms of they being investing in the equity of the in the banks, and particularly Bank of Baroda in particular, because these stock prices have not been the normal course, or we have not seen these prices for a very long time. So how sustainable are your earnings? What is the quality of the number that will continue so that investors can contained with remaining invested. Hello?
Yeah,
am I connected, sir?
Yeah.
And
got your question.
You got my point. And sir, for the ECL point also, sir, I would just like to understand, sir, what should investors keep in mind when this ECL implementation is being spoken about? There is a lot of if and buts about it. If you could just give for the benefit of investing community, there's some basic understanding of what this being all about. So that these were the only points.
So thank you very much. I think from our perspective, we believe that as far as the banking environment is concerned, it is very benign, and we should continue to see good returns from banks as we move ahead. Speaking of Bank of Baroda, I think while of course we benefit from the broader conducive environment, as I mentioned in my opening remarks, there are some special circumstances which make BOB again a particularly good investment. And the key differentiator as far as BOB is concerned is on the cost side, where we have been able to contain our costs far better as compared to our competitors. So therefore, I think there's a delta which is available to investors in BOB, which should give them confidence as far as the future is concerned. As far as ECL is concerned, to my mind, given where we are in the cycle, and particularly the corporate credit cost cycle is likely to sustain for the next few quarters and years, I think this has got implications which are again very positive, both in terms of the historical book, to also in terms of ECL, in terms of the historical record on which losses might be estimated. So I think we should be able to continue to report decent profitability numbers, notwithstanding whatever guidelines come in from the RBI in terms of ECL.
Thank you. I'm sorry, we'll have to close now. It is 4:30.
One at the head of the.
Okay.
Please.
Yes, sir.
Congratulations to Team Bob for an excellent performance. So we've done a lot of transformation, whether it was digitization, human resource, and reaping rewards today. You highlighted that we are touching few number of customers from our existing base where all the loans are concerned. So if you can highlight a little, elaborate that 5-10% have you reached, the capabilities far higher. Second thing, a lot of facilities which Bob started over a number of years led to this transformation. So without getting into details, can it lead to a substantially higher income within banks? Second thing, we are doing a lot of digitization where SME loans up to 1,500 crores are concerned, and most of the PSU banks have lost their market share in last 3 years in that business segment. How are we re-energizing that Bob captures those loans back from private sector and our earnings get better?
So thank you very much. So I think in terms of the capabilities in the bank and how that could actually translate into better earnings and revenues. First of all, I think there, as you very correctly have said, there have been a lot of investments that happened in the bank, not now, not in the last 3 years, but over the last 5-7 years, which actually are paying dividends now. Among them, I would again like to highlight two. One was again the investment that we made in creating a data lake, which we have been able to leverage now. If we had not made the investments then, there's no way we could have produced these results today. Similarly, again, investments, we talked in terms of the fact that the physical footprint, manpower, we are efficient and able to contain costs. That again was because the bank had the foresight and the management team then had the foresight to again invest in a shared services company, which again is taking a large part in terms of making sure that we are efficient and our expenses remain under control. In terms of the upside of what we are doing, I'll just give you the example that today, as a proportion of our loan book, unsecured loans are probably just about 2% or they're about 3%, right? About 25,000 crores as against a loan book which might 9 lakh crores or. Now the corresponding figure in SBI might be 5-6 times higher because SBI was able to start that very many years before we did. So that is again an upside which remains unexplored as far as we are concerned. So there's still a long runway which is there in terms of again our reshuffling a book, making it better margins. So today we have a 3.6% domestic NIM, but that is despite the fact that A, the credit card business sits outside the bank, and 2, the unsecured loan book is far lower as compared to some of the competing banks. So these are upsides which are still there for us to explore as we move forward. Third is again what you alluded to in terms of technology, which has now been brought to bear mostly on the retail book. But in terms of it having a transformative impact on MSMEs, that is still to play out. We have started doing that, but that is still, again, something which we are targeting relatively smaller micro MSME loans. Now, for us to move that to the mid segment, again, is an enormous upside that is available to the bank.
My next question is based on the global market outlook and domestic outlook, which RBI and the government is saying. The interest rate cycle you have already highlighted. Do you anticipate that the loan book growth, what we'll see with the view of election next year, would be more front-ended in the current year, first half rather than the second?
So, tough to say. Maybe again, we have our chief economist, Madan, there. He has been sitting quietly for a long time. Maybe we can ask him to give his views. Yeah, my mic for Madan, please.
No, in fact, for the current financial year, we are looking at overall credit growth being in the region of around 11 to 13%. Now, if you're asking whether it's going to be loaded in the first half or in the second half, is that the question? Yeah, we would tend to believe it will happen more during the second half. The reason being that both in terms of the consumption cycle as well as the investment cycle, whatever turnaround is going to happen more likely in the second half. Okay, so that's when we would see the demand for credit to really picking up. If at all, I mean, when we are talking in terms of one half being better than the second half, so therefore it will be happening more in the second half. So this will be based on the assumption that when we are talking of consumption increasing, because probably of a good monsoon, that is the basic assumption which we're making, there will also be good rural demand coming in. So as your consumption increases, there'll be higher capacity utilization, which in turn will generate greater demand for investment. That's how bank credit would keep increasing. So it will be more in the second half rather than in the first half.
We have a lot of news about our credit card, insurance, and other related services about IPOs. RRB also being spoken about. Anything we are likely to monetize? Partnership in the credit card, I understood, but the other wings?
So, Jaideep?
So, I think on the life insurance subsidiary, we are on the path of an IPO. We have received the DRHP approval from SEBI in March. We have a one year runway to get it on the IPO. But of course, given the conditions in the market, etc., we are again seeing what is the right time. So we will be taking a analysis of what is the right time to enter the market, and then we'll go for the IPO in the insurance side. BFSL and Nainital Bank, I think the processes are on for getting a partner into both these entities. And I think we should be shortly seeing some positive result there also. So that's on the monetization side.
Thank you very much. All the best for the years to come.
Thank you very much.
Thank you. We'll request our Chief Financial Officer.
At the end, one more, I think. Sorry.
Is there?
Yeah.
Yeah. Okay.
Yeah. Sir, Ramesh Bhojwani from Mehta and Vakil. Many thanks for taking my question, although at the last hour. Two important things. One, today the wholesale price inflation has fallen to negative and the retail price inflation has come down to 4.9. And RBI on June is very likely to announce a rate reduction, maybe 25 basis point, if not 50. And if we have a good monsoon, this reduction of rate cycle will continue going forward. In this situation, how is the bank looking at the overall rate cut scenario, number one? And the second question is little elementary or little away from this. Sir, no bank has taken steps to reevaluate their assets which are long standing in their books when they were made. Are we looking at evaluation of our assets?
So I think the first question, I'm not sure whether June is the time when there might be a cut. Maybe Madan can talk about that. But you're right that we probably are again at that inflection point where the cycle is going to turn. And it's a very relevant question. How are we as a bank prepared for that cycle? Now, so this is something we have been acutely conscious of when we were constructing our liability portfolio. So today, the major part of the incremental growth that we have seen in our liability book that has come from liabilities which have tenors of 399 days and below, right? So which would mean that should the interest rate cycle change, we are very well insulated from any adverse impact on our book, right?
Brilliant.
So the second part again was, I'm sorry, just lost track.
The revaluation of assets.
Revaluation, I think that's something the CFO can, along with his thank you, maybe he can address the question.
Thank you.
So like all the organizations you mentioned, we too have a policy for that, and we do it once in 3 years. So coming to my closing remarks, thank you everyone for coming for our in-person session. It's not always easy to travel in Mumbai. Thank you for being here, and look forward to seeing you again in the next quarter. Thank you so much.